In April 2026, a reporter for Axios walked into a neighborhood grocery store in Salt Lake City, Utah, the same store she had visited almost exactly 1 year before. She brought the same list. She compared the same 55 items. When she looked at the numbers, Navel Oranges were up more than 75%. On the Vine tomatoes were up more than 75%. Cosmic Crisp apples were up more than 30%. Ghirardelli chocolate bars, Oscar Mayer wieners, and bakery-made cupcakes were each up more than 25%. Of the 55 items tracked, 33 had gone up in price. 11 had come down. Eggs, which were expensive a year ago, had dropped sharply. The broad pattern was clear. What a family paid for the same cart of groceries in April 2025 is not what they pay today. What follows is a documented account of how that happened, the verified chain of supply failures, policy decisions, and economic pressures that now show up every time an American family shops for food. To understand the price increases at grocery stores in 2026, the starting point is not this year, but 2020. Over the 5 years from April 2020 to early 2025, food prices in the United States rose approximately 30% in total. That was not a spike. It was a sustained increase across nearly every category, the accumulated result of supply chain disruptions, labor cost increases, extreme weather, and higher energy costs. By 2025, new trade policies added their own pressure on top of an already elevated baseline. By that point, the average American household was spending between $500 and $667 per month on groceries, depending on the source and methodology. A family of 4 on the USDA's moderate cost plan was spending approximately $1,389 per month. The USDA's Thrifty plan, the budget designed for families with the least financial flexibility, came in at nearly $994 per month for a family of 4. These figures reflect a price environment that had not fully corrected since 2022, when food prices rose 11.4% in a single year, the largest annual increase in decades. That elevated baseline is where grocery prices stood when the events of April 2025 began. On April 2, 2025, President Trump announced a sweeping set of import tariffs from the White House Rose Garden, invoking the International Emergency Economic Powers Act, a law that had not previously been used to impose tariffs. The executive order placed a universal 10% baseline rate on goods from virtually every trading partner, with higher country-specific rates reaching as high as 50% on certain countries. In the days that followed, an escalation with China pushed the effective U.S. tariff rate to 21.5%, the highest level in nearly a century. The food industry's response was immediate and documented. Walmart CEO Doug McMillon said on an earnings call that all of the tariffs created cost pressure and that he was observing what he described as stress behaviors among consumers. Albertsons sent a letter to its suppliers in April 2025, stating directly, "We are not accepting cost increases." That letter reflected how hard the negotiation between retailers and suppliers had become, with shoppers caught in the middle. Procter & Gamble disclosed a total annual tariff impact of $1 billion and raised prices on 25% of its products. Its CFO described tariffs as a 5-point headwind to core earnings per share growth for the year. McCormick, the spice company, initially projected a $70 million tariff impact on its fiscal 2025 results and brought that figure down to $20 million by raising prices, cutting costs, and sourcing from countries with lower tariff rates. Constellation Brands estimated a $20 million hit from tariffs on aluminum alone. These were among the largest food and consumer goods companies in the United States, reporting concrete dollar figures being absorbed into their cost structures. Throughout the industry, the question was not whether those costs would eventually reach consumers, the question was when. Food manufacturers do not reprice products the moment input costs change. They work through existing inventory. They operate on supply contracts signed months or a year in advance. They negotiate with retailers and absorb costs where margins allow. When inventory runs out and contracts expire and margin compression becomes unsustainable, the price on the shelf changes. Industry analysts at the market research firm Spins placed the typical duration of that process at 12 to 18 months. Ben Lerman, SPIN's vice president of growth consulting, stated in January 2026, "It is not that there was no impact from tariffs because we didn't see consumer prices rise in 2025. It is just that they haven't had time to flow through the system yet. And it is in 2026 and potentially even late 2026 that we will start to see consumers feel a pinch of these higher tariffs." The arithmetic is direct. Liberation Day was April 2nd, 2025. Adding 12 to 18 months places the full pass-through window between April and October 2026. The price increases already visible at grocery stores in early 2026 represent the early portion of that transition, not the full extent of it. This is supported by existing measurements. According to the Council on Foreign Relations, all 2025 tariff actions combined pushed food prices up 2.8% and fresh produce up 4%. Federal Reserve Chair Jerome Powell stated in March 2026 that tariff effects account for between half and 3/4 of a percentage point of still elevated inflation. The Harvard Pricing Lab estimated tariffs added a cumulative 0.76 percentage points to the Consumer Price Index through October 2025. Yale Budget Lab's analysis found the average U.S. household is already facing approximately $1,500 more per year in food costs compared to pre-tariff trends, before the full pass-through has arrived. The price increases concentrated in produce are not accidental. They reflect how dependent the American food supply has become on imports, particularly from Mexico. As of 2023, Mexico supplied 63% of U.S. vegetable imports and 47% of U.S. fruit and nut imports. 59% of all fresh fruit available in the United States now comes from imports, up from 50% in 2007. 35% of fresh vegetables come from imports, up from 20% in that same year. For certain items, pineapples, limes, mangoes, bananas, and avocados, 88% of which come from Mexico, domestic production at the required scale does not exist. These are not products with readily available American substitutes. That import dependence explains why produce prices respond quickly to trade policy changes. It also explains why attributing every produce price increase to tariffs alone would be inaccurate. The on-the-vine tomato prices at the Salt Lake City store rose more than 75%. That reflects pressure on Mexican produce from trade policy, but also a separate event. Florida fresh tomato shipments fell 81% year over year in late 2024, following Hurricane Milton. Lettuce, up 15.3% year over year as of February 2026, reflects not only tariff effects, but a disease affecting California lettuce crops, agricultural labor shortages, and a seasonal shift between growing regions. The prices at checkout are the sum of multiple simultaneous pressures, not a single cause. Some of the sharpest grocery price increases in 2026 are unrelated to tariff policy and stem from separate structural failures in domestic supply. The U.S. cattle herd stood at 86.2 million head on January 1, 2026, the lowest level in 74 years. The 2025 calf crop was 32.9 million head, a record low, and the second consecutive year a record low was set. According to the American Farm Bureau, the cattle inventory will not begin to expand until at least 2028. The composite all-fresh retail price of beef reached a record $9.55 per pound in December 2025. By February 2026, beef and veal prices were 14.4% higher than a year before. Beef steaks were up 16.3%. Ground beef was up 15.2%. The USDA projects beef prices will rise an additional 10.1% in 2026. The cause is years of drought, record input costs, and a cattle cycle that has been in contraction for 7 consecutive years. A separate border closure to Mexican cattle imports, imposed in May 2025 to prevent the spread of New World screwworm, removed approximately 1.5 million feeder cattle annually from U.S. supply, tightening an already constrained market further. Coffee prices were up 18.4% year over year as of February 2026. Brazilian coffee imports now face a 50% U.S. tariff. The United States imports the majority of its coffee with no domestic supply at scale. This is a category where tariff pass-through is direct. There is no cheaper domestic alternative, and demand has not meaningfully declined. The USDA's food price outlook projects that in 2026, 8 of the 15 major food-at-home categories will grow faster than their 20-year historical averages. Beef and veal, fish and seafood, fresh vegetables, processed fruits and vegetables, sugar and sweets, cereal and bakery products, non-alcoholic beverages, and other foods. Only a handful of categories, pork, poultry, eggs, dairy, and fats and oils, are expected to grow more slowly than historical norms or decline. Eggs represent the clearest area of price relief in the current grocery environment, and the context for that relief matters. At the peak of the avian flu crisis in March 2025, Grade A large eggs reached $6.23 per dozen, a 368% increase from the average price of $1.33 per dozen seen in mid-2020. As of February 2026, retail egg prices are 42.1% lower than a year prior. The USDA projects they will fall an additional 26.8% in 2026. Egg production has been recovering as the avian flu outbreak that drove prices up has partially stabilized. The caveat is material. As of the USDA's April 3, 2026 egg markets report, 15.2 million birds had already been depopulated in 2026 across 23 confirmed outbreaks. The recovery is real, but the underlying disease pressure has not been eliminated. And for every dollar a household saves on eggs, higher prices for beef, coffee, produce, pasta, and beverages are absorbing that saving and more. A mechanism that has been limiting grocery price increases throughout 2025 is now approaching its limits, and understanding it is important for assessing what comes next. Throughout 2025, businesses absorbed approximately 80% of tariff costs, rather than passing them to consumers directly. This was a competitive and strategic calculation, not a structural commitment. Retailers and manufacturers were monitoring whether tariff policy would change, whether the courts would act, whether trade deals would reduce rates before full repricing became necessary. Supply chain expert Venki Ramesh of Alex Partners described the outcome. Around 80 to 85% of the costs were absorbed domestically, meaning either U.S. corporations had to take the hit, or they passed it on to customers, or a mix of both. That level of absorption is not indefinitely sustainable. Margins compress to a point beyond which further compression is not viable. When they reach that point, pricing changes. The 12 to 18-month lag the analyst described is the time it takes for that point to arrive across the food supply chain. For mid to late 2026, the expectation from industry analysts is that CPG brands and grocery retailers will begin raising prices in earnest across multiple categories simultaneously, a more concentrated and simultaneous wave than the gradual food inflation of 2021 through 2023. Morningstar projects non-durable goods, food, apparel, paper products, and cleaning supplies will rise 5.6% in 2026, nearly triple the pre-pandemic inflation norm for that category. For a household spending $800 per month on groceries, that translates to $45 more per month, or $540 more per year, on top of an already elevated baseline. In February 2026, the Supreme Court ruled the IEEPA tariffs unconstitutional, eliminating nearly 3/4 of the tariffs imposed in 2025 and triggering $166 billion in refunds owed to importers. The administration subsequently implemented new tariffs under Section 122 of the Trade Act of 1974, setting a 15% worldwide rate. Yale Budget Lab measured the current effective U.S. tariff rate at 11% as of April 2, 2026, the highest since 1943. The Supreme Court ruling has not produced lower grocery prices. Economics professor Carola Bender of the University of Texas at Austin explained the reason plainly. For a consumer, it doesn't really matter what authority the president calls on to impose the tariff. Some particular tariffs might go down, and so that could mean that prices of particular goods could go down, but the overall level would remain pretty high. Goldman Sachs analysts, writing after the ruling, noted that the bulk of companies passing on extra tariff costs to consumers has already occurred. Once a price increase is established at the retail level, it does not automatically reverse when the underlying policy changes. The supplier's cost basis has already adjusted. The retailer's margin structure has already shifted. Goods like food exhibit what economists call price stickiness. Prices rise quickly when costs increase and fall slowly, if at all, when costs ease. As of April 2026, food prices are 3.1% higher than a year ago. Beef is up 14.4% year over year. Coffee is up 18.4%. Fresh vegetables are up 5.4%. Sugar and sweets are up 5.7%. Lettuce is up 15.3%. The average U.S. household is spending approximately $1,500 more per year on food than pre-tariff trends would have projected. The USDA's forecast for 2026 calls for food-at-home prices to rise 3.1%, faster than the 20-year historical average. The prediction interval for that forecast runs from negative 2.3% to positive 6%, an unusually wide range reflecting the depth of current uncertainty in food pricing. The structural pressures that have driven these increases remain in place. The cattle herd is still contracting and will not begin to recover until at least 2028. Coffee faces elevated tariff conditions with no domestic alternative. The pass-through window identified by industry analysts is open. 73% of Americans across the political spectrum say they are worried about their ability to pay for groceries. 52% report feeling stressed about food costs specifically. The reporter who documented prices at a Salt Lake City grocery store on April 3, 2026, was recording what millions of families already know from their own receipts. The full accounting of costs generated over the past year has not yet been presented at checkout. Based on the timelines that industry analysts have documented and the structural conditions that remain unresolved, the expectation is that more of it is still to come.